Hey everyone, today on the final bar, we'll do our normal Monday routine, hitting the market from three directions: top-down macro, sector rotation, bottom-up stock picking. Some fascinating themes across the board overall. The S&P giving back some of its gains from Friday. Friday was accelerating into the close. Monday ends with a bit of a whimper with the S&P down just over 0.5%, but mid caps and small caps leading just fine, with energy and healthcare getting a bid. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together using the power of stock charts, using the power of data visualization, and get inside the head of all the other investors, the collective investor psychology, understand buying versus selling, euphoria versus desperation, supply versus demand, all the give and take that manifests itself in stock prices. And again, the goal of stock charts, the goal of the final bar is to help you make better decisions using data visualization, using the power of charting. And what we've seen so far year to date is a market that is very resilient, a market accelerating to the upside, depending on what you're looking at, something like cryptocurrencies. And today, the first day perhaps in the new year, feeling a bit of heaviness to the market with cryptocurrencies down pretty heavily across the board in something that should not surprise anyone given the trajectory that cryptos have had. But we're going to try to put all of these moves into proper context. Again, it's very easy to get caught up in the short-term supply and demand. Let's focus on the big picture and how things have evolved. And we have some fantastic guests coming through the final bar to help us make sense of things, to give us the charts and the ideas that are top of mind for them. This week's going to be really solid. On Tuesday, tomorrow, on the 12th, we have John Kosar from Asbury Research. John has a model called the Asbury 6, which is a great macro sort of big picture model about the overall health of the equity environment. Be interested to hear what it's telling him this week. On Wednesday, we have Doug Bush, one of my favorite stock pickers, who always brings a couple charts that I always wish I would have found on my own before he mentions them, but he has a great job of screening for ideas. I'm interested to hear what he's looking for opportunistically right now. Then on Thursday, our sector expert, Julius DeKempener from RRG Research, coming on the show. It's quite the rotation from more growthy to more value-y. We're seeing that play out again today with energy on the top, consumer communications at the bottom. So be interesting to hear what Julius's work is telling us. Finally, we are putting some finishing touches on our market outlook presentation, which comes up this Saturday, called Charting Forward 2021. It's going to feature a fantastic group of experts sharing with you their answers to questions like, where is the S&P headed through the course of the year? What about gold? What sectors are most likely to outperform and underperform? What stocks are coming up in your work? And so on and so forth. So it's going to be a lot of fun hearing what some of the top technical strategists and macro strategists in the industry are thinking as they look forward over the next 12 months. So don't miss that this Saturday, Charting Forward 2021. Let's get to our market recap. As we mentioned, on Mondays, it's three parts: the top-down macro, the sector rotation, the bottom-up stock picking. Let's start at the top-down perspective and see what happened today. And we'll look at some of the longer-term charts. So the S&P a little heavier today. Friday was really all about an acceleration into the close, with the S&P closing around 38.25. We didn't touch that level today. We gapped down in the open today, a little bit lower, rallied into the lunchtime hour, but then the afternoon gave all of that back and finished more toward the open for the day. So the S&P finishing around 0.2% lower, around 3,800. What was in the green were mid caps up about 0.25%, small caps about 0.4%. So this was not an everything down day. It was more about a rotation, about certain things working and others not. And if you look, energy was the number one sector with the XLE up 1.5%. And that's what, small cap tends to be a little overweight financials and energy relative to other cap tiers. And that's why it's doing pretty well. The NASDAQ 100 really heavy today, with technology in general not doing great. It was the mega cap stocks like the FANG names, which we're going to look at a little later in the show. The NASDAQ 100 down 1.5%. The VIX back up to 24. Bonds continue to weaken, and this has been a trend that we've seen evolve over time here. We've seen the scenario of higher rates and lower bond prices that continues through the course of the day, with the 10-year yield now over 1%, about 1.13. Commodities overall not doing great. You could see gold coming off a bit with the GLD down 0.2%, silver down even more. So we've talked about the long-term reversal, long-term potential for things like gold, but you're just not seeing it. And you're seeing things like the GLD heavier rather than lighter. This is after Friday rallying a bit into the close. I was curious to see if gold would continue up. So not much of a safe haven if you think of stocks lower, gold lower as well. Finally, cryptocurrencies, a lot of red. If you look, this is Bitcoin here on the little preview chart, touched 42,000. This was on Sunday's trading. So again, Bitcoin cryptocurrencies trade pretty much 24/7. So really peaked out around 42,000 and untouched just below 31,000 earlier today. So that's a huge swing in a 24-hour period. And overall, Bitcoin down around 13% from the close yesterday. So certainly some heaviness there. Let's look at some of the bigger picture charts and let's see how they've evolved through the course of the day. Here's a chart of the S&P 500. You could call today a doji candle, which is when the open and close are about the same. I tend to think of a doji candle as being indecision and representing a lack of conviction, because again, you have the opening price, you trade around it, that's the high-low range, but then you close right about at the same level. So directionally, you didn't really go anywhere during the day, and that's what we got today. And in general, tends to be a short-term reversal. Signal telling you the next couple of days more likely to be a reversal of the previous trends. That's suggesting a bit of a downward turn going into the next couple of days of this week. We'll have to see how that materializes. If and when the S&P would come off, and again, it's worth noting the S&P became overbought at the end of last week. It's for the first time since last August, and before that in June, and before that you have to go all the way back to January's high, which is before that February peak, obviously. So indication of the market rallying significantly. We kind of know that just from looking at the chart. Overall, it's all about what happens during any sort of pullback. There's plenty of room to correct and still be within the constraints of a long-term uptrend. First objective would be around 3640, 3650. That would include the 50-day moving average. That would include these swing lows from the last couple pullbacks. That's a pretty clear support level. We hold that, we're in pretty good shape. We break that, I think you have to start thinking about further downside. I wouldn't be surprised if at some point we get down to the 3200, 3250 level and retest the lows of that September-October period. But first things first, we have to pull back and break support, make a lower high. All of those things would most likely happen first, and that's what I would be looking for there. We're going to come back to cryptocurrencies. Maybe we'll finish there, but I just wanted to mention in terms of bonds clearly have been in a downtrend. We haven't seen much of a change on that. I think it's worth noting, I don't have the line extended, but if you look, the 61.8% retracement, which is taking the November low, the March high, and they're taking that range there, it's just below 150. It's around 149 and change. We're almost there, which means we're about to that last retracement level if you consider that to be the overall range in bond prices over the last 18 months or so. So it's worth noting we're at a potential area of support. If we break that, where there's not much below, going down to those November lows around 132 on the TLT, which is a long way down from here. Gold, silver have not been behaving very well. We had a bit of a potential breakout, but not a follow through. And we talked about breaking above the November high. That did not happen. That resistance held. Now the trend line's been broken. Now we're bouncing off the 200-day moving average. And that's where I would be focusing. We're right at the 38.2% retracement level. We're right at the 61.8% retracement level of the June to August peak. We're at a confluence of support right now. This is the level at which I would expect gold to hold, which is a nice rhyming pattern there. Overall, I think at the 200-day, at previous support, at the Fibonacci level seems like a reasonable place for this to hold. If it breaks it, though, I think you have to look a lot deeper, maybe going back to these June lows, down to 158, 159, which would be the next real confluence of support. The 200-day moving average really has to hold here, and that's what I would be looking at. I mentioned cryptocurrencies overall, and I don't want to spend a ton of time here, but I think it's just worth noting that we are at really near the first Fibonacci support level, which is right around 30,000. If you take the September low and you take that as the beginning of this exponential rise that we've seen, you take around 42,000, which we hit a couple days ago as the peak. You take 38.2%. That's almost right to the penny, 30,000, which seems like a reasonable point for Bitcoin to sort of pause this pullback. We'll have to see if that holds, but overall, that's a line in the sand I would be looking at. So opportunistically, this may be the point where we ride the next leg higher. If we break that, I think you have to go much deeper and think about the potential for much further downside. It's not surprising. We talked last week about what the Bitcoin did around 10,000, what Bitcoin has done around 20,000, which was back here. And in the previous time, it tried to eclipse 20,000. Maybe 40 to 42,000 is the next sort of big round number, at which point Bitcoin has to back and fill a little further. We'll have to see how the next couple days play out for sure. That's our big picture perspective, looking at some short-term weakness in stocks, but also metals and elsewhere. Not a lot working right now if you look at the overall macro picture, but there are pockets of opportunity. And let's transition into our next segment, sector setups. Let's focus on the 11 S&P sectors, how they're rotating around the S&P. In the middle, we're going to start with the RRG. As I mentioned, Julius de Kempener, who created this methodology, and whose work I've followed for years, is going to join us on the show on Thursday. So it'll be interesting to hear what he thinks of these rotations. But, you know, the general theme on the weekly rotation has been energy just working. And we've watched energy rotate way out of, you know, far away from the zero line, making this big clockwise rotation, now firmly in the leading quadrant for the first time in forever. The strongest sector, though, on the weekly rotation is the financial sector, the XLF. So furthest to the right means the strongest trend, and we've seen financials, the strongest. Energy could certainly eclipse it within the next week if it continues on this trajectory of relative outperformance, but overall financials, energy number one and number two. After that, sort of the next bucket would be industrials and materials, which are down here. Overall holding in just fine, far away from the zero line in terms of further out to the right on the x-axis, which means the outperformance has been pretty solid. Materials have come up a bit, heading in the right direction, which is encouraging. The next three are a bit of a concern. If you look at technology, consumer discretionary, communication services, none of them are heading necessarily in the right direction. They're all heading to the left, which means the relative momentum is dissipating. It's kind of coming off. So overall, while it has been outperforming, it's not as impressive as it has been before. So you're really looking at the value sectors that are really starting to work here. And you've probably seen that just from the movement in stocks, the movement in sectors, but the RRG work is certainly confirming that. Let's look at the 11 S&P sectors now using the candle glance function. This is where we can spread a bunch of pictures out on the table and start to separate the wheat from the chaff, separate what works from what doesn't work. And if you remember the two sectors that looked good on the previous visualization, it was financials, it was energy. Let's look at those two charts to start with. The XLF has had a really impressive run. If you take February to March as the downtrend, we have now 100% completed the round trip back to those previous highs. And now the XLF has broken above 3050, tested it from above on Friday, and now has bounced very nicely up 0.3%, which is not a huge win, but it's above zero when the S&P was down. And overall, you know, we often talk about how resistance becomes support. The question is it able to hold? So the very first line is, can it hold 3050 on the XLF? Can it hold this previous high? A lot of financial stocks and a lot of financial ETFs have a similar pattern where they are at or near all-time highs. And what we're going to look at in a little bit is JP Morgan in particular, because depending on whether you adjust the data for dividends or not, you're going to get a little bit of a different picture on where it's at relative to the all-time highs. And I'll show you what I mean by that in a little bit. So whether or not you adjust the data might make this look a little more or a little less compelling, depending on how you do it. But if you do adjust the data, which is sort of our default methodology, it's broken out, and you want to see if that support's able to hold. What's more impressive than anything on the top panel is what's happening on the bottom panel. If you start the clock the first week in November, it's been an incredible run of outperformance. And look at this rotation from underperformance to consolidation, meaning it's in line with the market. This is in sort of the late summer to early fall months. And then look at how the outperformance really began there in the first week in November. And it just continues, continue to push to the upside. This is why the KBE, the KRE all looking pretty solid. We'll look at those here in a little bit. So financials overall doing beautifully. Energy is number two to look at. And you can see how it also has made this beautiful pattern of higher highs and higher lows. You can see how the relative strength has improved, coming off again around that same level. That early November period to now is where you've seen this real rotation into financials and energy that has persisted. This is when it gapped out of those lows, made a new swing low, a bullish engulfing pattern, and then just has not looked back. And in general, if you're wondering what to do with a chart, zoom back, zoom 30,000 foot view and look, are the highs getting higher? Are the lows getting higher? And that's exactly what you're seeing here. When the XLE pulls back, it's higher than it was on the previous pullback. When it breaks out, it tends to break to new swing highs. We just saw that on last week. We made a new swing high. Today, we're sort of rotating again, closing to a new swing high as well. So seeing this continue is going to be key. 45 is really the line in the sand. That's the previous high from June. So looking to see whether it's able to hold that, or whether it's able to eclipse it, really follow through to the upside, would be really, really meaningful. The third one I want to mention is healthcare. This is one of our 3 and 3 charts on Friday. And I think a lot of people have forgotten about healthcare as a sector because it's been all about the growth, technology, communication services, consumer discretionary versus the defense, things like the value, things like energy, financials, value-oriented spaces that have started to really emerge. Materials, industrials obviously have done pretty well on a relative basis as well. Healthcare is one of those kind of weird other sectors. There's some defensive qualities to healthcare. There's some offensive qualities relative to healthcare. You have biotechs, but you also have the big blue chip pharmaceuticals and a bunch of other things, supplies, devices, all of these as well. What is undeniable is that the XLV has broken to new highs, new 52-week highs, multi-year highs. It's continued to set resistance levels, basing patterns, and have broken out. We saw that here in 2020 with the break higher in the summer. We then saw this new base that formed around 109 on the XLV. You can see we broke out there in November, retested it, and now following through to the upside. So this pattern has continued. The relative strength hasn't been incredible yet because it's still rotating higher and it's chopped around a little bit, but overall the last month for sure has been stronger, and you're starting to see potentially some upside emerge here. So if you've not been looking at healthcare, if you've been looking at elsewhere, and we've certainly been talking about opportunities elsewhere, it might be an interesting one to revisit to see how some of these different groups have done, because you're starting to see some strong performance really begin to materialize. That is our sector setups for this week. A lot going on, a lot of movements, a lot of questions that I'd love to answer with you. We need to take a quick break. We'll be back with our next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So great to have you on board as we review these markets every day at 6 p.m. Eastern during the week. As a reminder, we'd love to hear from you. We've had some great questions from you guys all through last year and also the beginning of this year. And we'd love to hear from you, answer one of your questions in our mailbag segment, which will be on Tuesday's show and also Friday's show of this week. Shoot us an email with any questions that you have about the markets, about charts, about technical indicators, trading discipline, decision-making, investor behavior, psychology, whatever it is. The Final Bar at StockCharts.com is our email. On Twitter at FinalBarSCTV. Just tag us in a comment. Finally, on our YouTube channel, just put a comment right below the video that you're watching. Again, we've received so many great questions from you. Keep them coming. Anything on your mind as you're analyzing your charts, we would love to help point you in the right direction. Our next segment is called Shifting Stocks. We've talked about the big picture, about the S&P potentially starting to pull back a bit, following through from yesterday's nice accumulation phase. We talked about sectors and this general rotation away from things like tech and consumer into things like financials and energy, which seems to be continuing so far this week. Now let's look bottom up and let's look at individual stocks and what sort of lessons we can get from that. A lot of the charts we're going to look at here are fueled by my own weekly routine, which is sort of Sunday into Monday. I usually look at the S&P 500 charts one by one and look for key patterns. And it's a practice I've done for years, and it is hard to be caught off guard with price movements if you look at the same set of charts every week. And I would encourage you, if you don't have a good weekly routine like that, please take some time and think about how you can start to do it. Use some of the charts that we use on the show as a starting point for that. If you're not sure how to get started, or just think of some of the things we look at that may be a part of a good weekly routine for you. Let's start with the FANG stock. So I was asked in some financial media outlets this morning about the FANG trade and what was happening today. Obviously, we had news over the weekend with Twitter and Facebook and Alphabet, right, with different apps and the president and tweets and all of that. And so again, a lot of that's outside the scope of what I would want to focus on the show. Let's focus on the charts and how they've reacted to that. But certainly when you're looking at the FANG stocks, there are a lot of different inputs here, right? There's a lot of different headwinds and tailwinds. And I'm often asked, what is this stock going to do because of this one news event? And while I can try to anticipate what that's going to be, the reality is nothing like that happens in a vacuum, right? A chart like Facebook or a chart like Alphabet is subject to a lot of different headwinds and tailwinds at any given moment. These are huge benchmark names, which means if overall investors are allocating more into equities, these stocks are going to be bolstered by the fact that a lot of people need to own the big names. A lot of ETFs are going to need to own these names to get the right exposure. So the demand that just comes from wanting to own equities tends to fuel a lot of the mega cap stocks, especially these FANG stocks as well. You also have the tailwinds of the Fed and other things that we've talked about. On the other side, though, you clearly have this general rotation. These stocks have felt the pressure of regulatory challenges, regulatory hurdles, and the expectation of future regulatory challenges, right? And just how these companies, these big conglomerates in technology and communication services, are going to be able to continue, given what feels like growing resentment for their business models and the way that they're trying to increase value for shareholders. All of that, all of the above should and can be and is reflected on the price of the chart. And that's why we want to, or the price of the stock. And that's why we look at the charts to not guess what's going to happen based on news flow, but focus on what is happening based on the supply and the demand from investors. Having said that, the New York FANG Plus Index, which includes things like Facebook and Twitter and Netflix and Alphabet, overall has been in a nice solid uptrend. Now it looks maybe a little better than it is on a relative basis, because on a relative basis, it's really stagnant. The last 6 weeks haven't been dramatically good. It's not really gone down on a relative basis. It hasn't gone up anymore. And really the relative peak was here at the end of October. This is when other things really started to emerge. If you go back and mentally rewind to the charts of financials and energy that we looked at a couple minutes ago, you can see why the relative strength here is less attractive, because those sectors are really starting to outperform and break to new highs, while the FANG stocks are sort of stagnating a little bit. Now, having said that, that's grouping all of them into one index. Let's look at them individually and see what patterns we can see. Facebook is arguably one of the more concerning ones, because if you look in the short term, you're starting to see a pattern of lower highs and lower lows. Facebook has broken down through support here for the first time in a while. We talked last week about how 260 and recently about how 260 was a pretty key level. This is where we found support back here in October, November. You can see we've now broken down through that. The 200-day moving average is not too far below where we're at right now, around 246, which lines up with this low from back here in mid-September. So if and when that's able to hold, that might be a really interesting actionable pullback level. If that fails, I think that speaks to a lot more potential downside for this FANG trade and really the further fueling the potential of upside in other sectors. You can see the rest of these charts don't look great in terms of following through to the upside. Apple has failed at its previous resistance. You have this great distribution candle patterns. This is a bearish engulfing pattern that you saw back here. That was at the beginning of September. Here we have what's called a dark cloud cover, where the big down candle finishes at least 50% of the way down. These are all distribution patterns as it's testing previous highs. So while not in a huge downtrend yet, it's failing at previous highs, which is concern. Netflix has really been in a stagnation phase, right? I mean, it's been in a range. You draw a big rectangle around this period, and you can see that it continues to be pretty much midway there. It's down at the lower end of that rectangle now, and the 200-day and these previous swing lows were right at that point. Around 475, 480 would be the line in the sand there. Microsoft as well, sort of really probably the most average, the most neutral of all of them. Alphabet as well has come off a bit, but overall sort of in the middle of this range. Amazon, weaker. So you can see about half of them are sort of weaker, testing resistance, beginning to test the lower end of the range, potentially breaking down through some trend line support, depending on where you draw them. Some of them are holding up a little bit better and are more mid-range. I'd be very keen to see how these stocks hold off here. I think this is part of a big rotation away from mega cap tech and into things like financials and energy. I think that's a pattern that's going to be with us for a non-zero number of months during the year 2021. I think the question is just how the market interprets it here in the short term. Again, based on the 2010 analog that we've talked about previously, I think choppiness and potential pullbacks here in January, February make a ton of sense based on that analog. And I think we might be seeing the early stages of that. Now, if people are rotating away a bit from some of these mega cap tech names, the FANMAG names, if you will, where are they going? So we need to look at financials and energy, and just to go a little level or two deeper than what we talked about previously. When you think of financials, I'm looking at things like banks, the KBE, which is a bank ETF. Look at the nice gap higher we had last week. Bit of a pullback and now moving back higher. Closed up around 1.25% there. That looks at the close. Overbought, which doesn't bother me too much because that just means it's gone up a lot. But the relative strength since September, the end of September, is what is most impressive there. Regional banks, KRE, also looking very similar in terms of the price profile. Also overbought. Also an incredible run of relative performance. Overbought here doesn't bother me. That means, to me, it speaks to the fact that these stocks have rallied. You could see a pullback, but I would consider those more opportunistic. These are the types of longer term trends that I think are going to continue to work given interest rates that are increasing and certainly have further upside to go. Now, JP Morgan, if you look a level deeper, it really depends on how you break it down. So here's the chart of JP Morgan. If we adjust the data, which is sort of our normal routine, which means you're adjusting for dividends. If you look there, you can see here that we're actually at all-time highs. This is the chart of the XLF that we looked earlier, right? We broke above all-time highs. Now we're pulling back and testing support and bouncing higher overall, setting up beautifully. I think it's a really nice chart. If you don't adjust the data, which means you're taking the dividend adjustments out of it and you're focusing more on the price behavior itself, you can see we're not quite to all-time highs. And so I think we're nearing that really key level. Though what concerns me, maybe if anything, is if you think of the charts of mega cap technology, things like Microsoft and others, they ran into trouble. Apple has run into trouble trying to push above its previous highs, right? Sort of hits resistance, and that's where it ends. Could be this beautiful double top when we look back months and years from now. That could be what we're seeing here with financials. It's all about powering through resistance, hitting resistance, meeting it, breaking through, and seeing follow through. And that's why I think charts like JP Morgan are really important ones to watch right about now. That's all the time we have for our shifting stock segment. So many themes, so many scooter rankings to pick out. So if you didn't have a chance to review charts individually, go to our scooter rankings, look at the ratings, and focus on some of the stocks that are working and stocks that are not. We need to wrap the show and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 comes with a big shout out to some of our very knowledgeable and aware viewers who called me on Friday when I was looking at the sentiment readings. You can probably pick up the questioning in my voice, and I'm making a note on the right saying, boy, I'm amazed that the AAII survey is not higher given what the market has done last week and finishing near the highs. It turns out it was. We had a data glitch, which we've now corrected. So it's 54% of bulls right now, which is near the highest readings that we've had. That makes so much more sense to me in terms of where we've been historically. And I think what should be concerning is, again, I think you could describe with over 50% bulls, the adjective I would use for that is euphoric. And euphoric for me with the AAII survey doesn't mean the beginning of something much further to the upside. It tells me we've gone far enough and we have some downside to back and fill. And so that's what I'm looking at there. Chart number 2 is the XLF, the financial sector. We've talked about adjusting the data or not, so just keep that in mind. Anytime you're looking at all-time highs, all-time lows, you're looking at key support and resistance levels. A lot of times just put an underscore before the ticker. That'll give you the unadjusted version. That's better for looking at support and resistance levels, but adjusting the data is better for relative strength. It's better for technical indicators, and that's why we tend to default to that. Having said that, the XLF and financial stocks are at or near new highs, and I think we're at a really key juncture. This is why it's an important chart to watch this week. Are we able to break above, break out, and then follow through? The relative strength has been truly impressive, though. Finally, we have JP Morgan. Here we're actually unadjusting the data. You can see the swing high, the all-time high here, the beginning of 2020, or the long-term high. You can see how we're nearing that level around 140. We are at a really key point as JP Morgan, for the first time in I don't know how long, potentially becoming extremely overbought, which speaks to long-term strength and long-term potential to go further to the upside. So that's a third chart to watch. Folks, that is our show for today. Thank you so much for joining us on the Final Bar. As a reminder, our special charting the year 2021, charting forward, is coming up on this Saturday. So look for that on StockCharts TV and on our YouTube channel. A special shout out to the Ohio State Buckeyes going for the national championship tonight. Go Bucks. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.